Hello and welcome to Livewire's C-Suite reporting season coverage. I'm Ali Selby, and today we're joined by MA Financial Group's joint CEO and Executive Director Julian Biggins for an inside look at the company's latest result and a sneak peek into what you can expect over the coming 12 months. Thank you so much for joining us today, Julian. Really excited to feature you in our reporting season coverage.
Great, really appreciate being here, Ali.
Okay, you just released your latest FY23 result. What are the key numbers that you think investors need to be aware of?
Yeah, the result was released last Thursday. I think we're really pleased with the operating metrics of the business, and I think when you look under the hood, when you look at the actual numbers, all of the operating numbers for the business are going really well. I think about asset management, where we've got inflows. We've nearly hit $2 billion of inflows over the period. Our loans on platform for Finsure are up 21%. And our MA money books nearly hit $1 billion. So these are really strong numbers for our business. We are lapping some very big numbers from last year, so clearly you can't win in every number, but we're really pleased with the overall track record of the business, and we're looking forward to hitting our FY26 targets.
Yeah, let's stick with that. Net profits, revenues and earnings underperformed analyst estimates. What do you think went wrong?
Earnings definitely underperformed the estimates. The revenue numbers were actually pretty much in line with consensus. I think from an operational side, we invest for the future. So really, how do you think about long-term investments and how do you think about getting short-term earnings? They don't always marry perfectly. And over the last 15 years since we founded the business, we've had a very good track record delivering on those strategic initiatives. So we think we're planting seeds that will deliver a lot of growth in the future. Short-term earnings was impacted this year by what I'd say more cyclical sort of things. So corporate advisory was hurt by the volatility in the equity markets. Transactions were harder to get through because confidence levels were low, but these are really cyclical impacts on our business. When I think about recurring revenue, so what's really valuable in the business, we grew our recurring revenue by, I think, 25 million over the year, and that really underpins the business for the future.
You talked before about planting seeds for the future. What are you doing to improve for FY24?
FY24, we've had a very consistent plan. So I think, whether it's growing our inflows into our asset management business, so what really drives that is having great product, but also having great brand positioning. So, we're very much, we know who we are and we know who we aren't, and we're really focused on providing defensive income to those investors, both Australian and foreign investors into our business. Finsure, again, growing strongly, and also MA Money is one of our newer, seeds that has been planted. We expect MA Money to break even late in FY24 and then start contributing very positively through 25, and we'll put a forecast out there for 15 or 20 mil of NPAT in 26. And that's, put it in context, that's quite meaningful for our business, where it could be 10 cents of earnings for shareholders. So, as significant investors or shareholders in our business alongside our fellow shareholders, we really do focus on those medium and long-term targets for the business.
You talked about asset management inflows growing last year. They were up 27%, or 27% higher than 2022.
Yep.
Which funds received the most investor interest? I'm really interested to know.
Well, I think it's a very hot topic at the minute, but private credit is definitely the flavour of the years. And when you talk about sort of defensive returns, defensive downside risk management, the private credit funds are offering 8 to 12% sort of annual returns, but with a lot of defensive characteristics. So I'd say of our gross flows of 1.9 billion, probably 90% of it went into private credit. We're quite strong in alternative real estate as well, through the pubs, marinas, hotel accommodation assets. And we launched the MA Marina Fund last year. Surprisingly, it owns marinas. We took about 150 to 160 million of equity into that strategy, and that's performing exceptionally well. So we're very happy to have that portfolio. It's a very unique offering, and we think investors will do pretty well out of it.
Everyone's been talking about rising interest rates and inflation over the last 18 or so months. How has that impacted MA Financial?
It's a bit of a confidence game, rising interest rates. So, whilst there's uncertainty in the market about when will they finish, we saw interest rates go from essentially 0 to 400 points very quickly. And that impacted confidence and made markets very volatile, and also made decision-making quite difficult to be decisive. So I think there's a very strong tailwind for us as interest rates roll over. I think there's still some uncertainty around inflation, and are we at the end of the interest rate cycle? Clearly, we're closer to the end than the start, because we've gone from 0 to 435 basis points very quickly. So I think we'll see that tailwind help our business in the near term.
Okay, but did it impact the asset values or anything like that?
It impacted asset values slightly. So in the pubs business, in our hotel, in our hospitality business, we've probably seen cap rates push out 100 points through the cycle. And I think the good thing about our hospitality business, there's actually a lot of transactions that are taking place in the pubs. So we've actually got real evidence of what asset values are. I think in some of the more core asset classes, such as the commercial building we're sitting in or in sort of retail shopping centres, there's just been less transactions. There's still a bid-ask spread between buyers and sellers, so there's less certainty where those assets will fall. We've probably always had a bias towards high yielding assets. And I think that's probably played out well through a rising interest rate environment because we've had more buffer in our valuations and our yields, so we've been impacted less than some others.
MA Financial's diversified across quite a lot of different businesses and geographies.
Yep.
Where do you see the most potential over FY24?
We listed the company in 2017. We were in Sydney and Melbourne. Today we cover Hong Kong, China, New York. So we've got quite a few geographies we cover. We see a lot of growth in Asia still through high net worth investors looking to deploy capital or diversify their wealth globally. And we also see a massive opportunity in the US where we've planted a seed. We've started our US private credit platform over there. It's very early days. That's the largest credit market in the world, and we believe that our growth in the US could be quite considerable. It's more medium to longer term, but that's definitely a big market for us.
How do you avoid diversifying for the worse? Or diversifying?
We think about I use the word planting seeds here a bit, or the phrase, but we think about diversifying in a very measured way. It's been sort of in our DNA from when we started the business. We say you don't bet the farm. You can buy expertise, but you don't make material investments without really being well considered in terms of your past. So in the US, we've probably invested around $8 to $10 million to start with. In the context of MA Financial, that's not a huge bet. But we've bought people that have a 10-year track record, 30-year track record doing business in the US, but a 10-year track record in their current structure, that then we can take our expertise and help elevate their business as we work through the US and basically the funds management process in the US.
You talked before about alternative real estate assets and the marina asset. How do those types of funds perform in this point of the cycle?
Yeah, I think when I think about alternative real estate and what does that mean, these are really, you're looking at underlying cash flows. So you're trying to work out the drivers for a marina. A marina is a great example. If you turn the clock back to the GFC and how did the marinas operate, their revenue streams actually went up. So that's quite surprising. But if you think about a boat, it's very hard to move a boat. Once you've built it, it sort of needs to be somewhere. If someone doesn't pay their mortgage or their finance on the boat or it gets repossessed, the bank's still got to park the boat somewhere and pay the fees. So the marinas are an incredibly robust business from a revenue perspective. And what I also like about the marinas is there's just very little supply of the marinas coming into the market. So if you're in Sydney Harbour, the supply and demand fundamentals are very strong for the owner. And we've seen very strong rental increases come through those assets.
Okay, I want to talk about the outlook now. Corporate advisory was kind of on pause in 2023. We've seen some action already this year, some corporate action and deals. What's your outlook on corporate advisory and corporate deals in 2024?
Yeah, it's a good question. It's very relevant today. There's been 2 deals, I think, announced today in the M&A space, and it seems that confidence levels are picking up. I'd say we've been quite active. I think we've had 5 or 6 deals announced for the start of the year. What plays out for the rest of the year? I think the thing that's really been missing from the investment banking market is the equity capital market activity. So we really need, I think people want the markets to go up. I think they're willing them up. And we have seen more equity deals at the start of this year. But when we're sitting in February, it's a long way to play out to December. But we're optimistic, but at the same time cautious, if that makes sense. But obviously interest rates will have a massive impact on the year, and whether we see interest rates roll over or go up will have a determinant for where the investment banking corporate advisory business lands.
Would you be able to reveal any of those deals that you've been working on at the beginning of this year?
We're reluctant to, but there's a fair bit of activity in the market today. There's been a few bids, and one of the deals that we've been working on lately is the Praemium's bid for OneVue, or Iress's OneVue business. We think confidence levels are picking up, but markets can change very quickly, as we've seen. So what I'd like to see is a confident board, a confident market for M&A, but also a confident market in terms of pricing. So you see the share markets will support further M&A.
In the report, you guided that there could be weakness in revenue margins in the asset management business, and you also said that continued investment would impact FY24 earnings by 6 cents per share. If that is the case, why should investors stick around for the ride over the coming 12 months?
I think about track record of what we've delivered over the last 15 years. Again, we used the IPO as a bit of a pivot point where we generated $70 million of revenue in the forecast. This year we generated $270 million of revenue, so we've sort of grown things 2.5, 3 times over that short 6-year period. And when I look forward to FY26 and the targets that we've put into the market around what we think our business can deliver, today we've got about 9.4 billion of AUM. We think we can have $15 billion of AUM by 2026. Every year that goes past, we get close to that date. And we also think within Finsure, our MA Money business, there's a lot of growth. So whilst we've obviously had a knee-jerk reaction to our result last week, I think the operating performance has been very consistent over the last 3-4 years of delivering strong operating growth. And investors should be excited and optimistic about the future of MA Financial, as I am.
Okay, well, thank you so much for your time today, Julian. I really enjoyed that chat.
Thank you, Ali.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.